All right, my friends, I think we've been suckered into falling for the belief that we need to defer our accounts into tax-deferred accounts like IRAs, 401ks, the whole thing. Actually, look, it's not a conspiracy by a stretch, but I think how convenient it is that when you retire and the bill of goods you were sold that, oh, all this deferral, you'll pay less income tax later because you're not working and you'll pay. So you're saving when you're in a 22% tax bracket. When you retire, you'll be in a 12% tax bracket. I think there's some legitimacy to that, but the idea of defer at all times is just, I think we got to break this habit. And the reason is actually quite simple, like all of the videos I do. The facts are, when you're working, right, it's kind of like going back to everyone needs mortgage interest. You don't want to pay more taxes, do you? You can take a mortgage interest deduction. And I've heard that 1,000 times Sunday too. It's freaking stupid, man. The vast majority of people don't itemize. They just don't. I gotta make sure I look out for a turtle running around here. This is Turtle Alley where I'm at right now. And some freaking piece of crap ran over a big turtle that it breaks my heart and it angers me in something wicked. What are all these ducks doing over here? What are y'all doing? Quack, 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 quack. They're all looking at me like, that guy's weird. All right, anyway, so going back to what I was saying. The vast majority of us don't itemize. If you're not itemizing, you're not getting a mortgage interest deduction. So whatever anyone says, the bank, you could take a deduction. Yeah, you can take a deduction, but that's probably going to cost you more in taxes. It's certainly going to cost you more in income if you have a debt on the loan. You don't need a freaking, I hate that. My CPA says I need the interest deduction. Like, are you even doing itemization? All right, so let's go back to the default for deferring. All right, remember the median household income in America is $60,000. All right, so that's the median household income. And we'll even say for workers, folks who are working, we're going to say the median income is $80,000. All right, so if you're employed, your median household income is $80,000. What the heck was that? That was weird. It looked like a small moose was in that doozy neighborhood. It must be like a full moon in the middle of the day or something like that, because things are just being weird around here. All right, so $80,000. We're going to say you're under the age of 65. We'll say you have a $25,000 standard deduction between you and your missus. So that's 80 minus 25 is a $55,000 income. All right, so you're putting 10% of your salary into a 401k. All right, so now you have $50,000 is taxable. All right, so that's 50,000 times 12, whatever that is. That's that's $6,000. Wow, 50,000. That's $6,000. So 50,000 times 12 is going to cost you $6,000 in income tax. So I've been talking about FICA, just income tax. All right. Now, if you have $55,000, that's going to cost you an extra couple $100. I don't know what it is. All right. All right, so we know you're saving, we'll say $500. Well, I guess it won't be 120, I think let's just say $500 for simplicity. I can't figure it out, and then I'll hit a car crash. All this lump of coal will be burning. All right, so you got $55,000 because you did not do the 401k deferred account. You just put into an after account, a Roth is what you should be doing. All right, so what tax bracket are you in? Well, you're in a 12% tax bracket if you're married filing jointly. All right, what's the likelihood you'll be in a 12% tax bracket once you retire? Pretty high. In fact, you'll be in a 15% if the Trump tax bill goes away. So what happens here is that not only will you have money from your retirement accounts, but you'll have Social Security in addition. Thus, you'll have two sets of income. All right, because I've talked about how the tax torpedo, how it hits the lower income earners in particular, those with a couple $100,000 in a 401k IRA that's deferred plus Social Security. They're the ones going to be hit the most because of how it works. Like I just showed you with I didn't put a name on her. I think I said Jane. I like single Susie's always easier to say, but we'll say Jolly Jane. When she took that $40,000 distribution from her IRA. It was a 40% tax increase on the difference between $15,000 she took out and $40,000 because the way the tax structure is with Social Security. Because not only does it add $40,000 of taxable income to her IRA, it adds a lot more of Social Security that was going to be subject to tax that before that was not. So she's basically paying like I said, a 40% of marginal tax rate on that $40,000 distribution, simply because of the way the tax code is. You can scream bloody murder and yell at the freaking clouds, but that's the way it is. Now, if she would have had that paid, an extra $500 or $600 today in taxes and had that not in a deferred account, but actually a Roth or even just a good old-fashioned taxable account, she would not be paying that. The Social Security would not then be subject to taxation. It's literally that simple. So everyone in their mom says, yeah, but you're business. That's what they always say. But the $500 she doesn't pay in taxes, she could invest it. I mean, again, that's fine. That money will grow. I get it. Absolutely. It doesn't remove the torpedo of the Social Security taxes. It just does not. Stop this whole but the money invested can grow, Josh. It can. It just means more taxes for you. So the way I look at it, on top of that, it's going to be more taxes for you at a higher tax bracket, most likely, and one that could be going up as well from 12 to 15 because they get rid of the Trump tax bill, and then it goes 22 to 24. Those aren't 22 to 24 anymore. It goes 10, 15, 25 is what it is. All right, so basically, if she stays in the 15% tax bracket, she just went up from 12 to 15, and then she could be easily going to 25 as she gets older and more money has to be pulled out from her IRA. Where I'm going with this, my friends, don't just default to the tried and true in BS of just defer. That's not necessarily the way to be. I'm not saying it's not. Now, like for me, it would make sense because I'm making good money this year. Last year I did too. So let's just say I'm in a 24% tax bracket. Or 22, 24, something like that. Let's just say I'm in a 22, 24% tax bracket. When I retire, I won't be because I'll have Social Security, some money from my IRA, but most of my money will be in after-tax accounts. And on top of that, I'll have, did I already say reverse mortgage? I did say the reverse mortgage I'll certainly take for income. And I won't even have a mortgage at all. I just won't need that kind of money I do now. All right, so at the end of the day, be careful just defaulting for deferred accounts. I think it's a trap you can fall into, and it really limits your ability to hedge. And what I mean by that, let's just say you're under the age of 59 and a half, and let's just say you want to go on a vacation. Well, you need $40,000 out. Forgive in Roth conversions, but you need $40,000 to go on vacation. You're under the age of 59 and a half, where are you going to get that money from? Well, you're going to get from your IRA. Well, how much is it going to cost? Well, we know if $40,000 is immediately going to cost you $4,000 in penalty, and we'll just say, for simplicity, a 15% tax bracket, or I guess a 10% tax bracket. It's going to cost you probably $10,000 of income tax when all said and done. All right, so it's going to cost you, you're going to have to take a $50,000 distribution to cover a $40,000 expenditure, and that's if you're under the age of 59 and a half. If you're over the age of 59 and a half, it's still going to cost you probably $45,000 to take a $40,000 distribution. And then you add to it, if you're on Social Security, how much it costs additional Social Security income you have to declare. There's just so much going on. I just invite you to be cautious of just defaulting to defer. I'm telling you, I would say more often than not, it's not worth it. I really do believe that. If the median household income is $60,000, I don't think you should be deferring. If the median working household income is $80,000, I don't think you should be deferring. If you're in the 22%, 24%, maybe for sure. Obviously, you're higher than that, absolutely. But if you're in the 22, maybe. If you're in the 24, probably you should defer. But certainly, if you're in the 10 or 12, I would not be deferring. I'll tell you that right now. All right, we'll see you.